Hello and welcome students. In the last video lecture, I explained you the types of accounts that are basically two types of accounts, that is personal and impersonal account. In impersonal account there are again two subparts of impersonal accounts, that is nominal account and real account. So on the whole there are three main types of accounts, that is real account, personal account and nominal account. Also we had discussed that which type of transactions are considered as real account, nominal account or personal account. Real account includes all those transactions related to goods or assets related transactions. It means any kind of purchase, sales, any kind of assets that we have purchased, then all that type of transactions will be included in real account. The second one, that is personal account, means any kind of dealing or any kind of transaction with any of the person, whether it may be any natural person or any artificial person. Suppose we have purchased the shares of any of the company or any of the company, then it is called an artificial person. Okay, but suppose we have sold the goods or purchased the goods from any of the particular individual, then it becomes a natural person. So any kind of dealing or transaction with any natural or artificial person, they are included in personal account. The third one, that was nominal account. Now in nominal account, all those transactions related to expense, losses, income or gain related to the business, that are included in nominal account. Okay, so that was the already the topics that we have covered in the last video lecture. Now in this video lecture I am going to explain you the rules of debit and credit. Already we discussed that there are two effects or dual effect of any of the transaction. One effect that would be debit and the other effect that would be always credit. Okay, so let us understand the rules of debit and credit of all the three types of accounts. Okay, you can see on the board I have already written the rules of debit and credit. The first we'll understand the rules of real account. You have to remember these rules by heart. On that basis only you will be able to do the consecutive chapters. Okay, so the first rule for a real account for debit, it is debit what comes in. Anything, whether it comes, whether it may be goods or assets, anything whether it comes in the business, then it is debited. Debit what comes in and credit what goes out. Anything that goes out, if we have sold the goods, then goods will go out. If we have sold the assets, then assets will be sold, will go out from the business. So credit what goes out, debit what comes in. Okay, so anything whichever comes in the business, whether it may be goods or assets, then you have to debit, and anything that goes out, whether it may be goods or assets, then it will be credited. So debit what comes in and credit what goes out. You should remember this rule by heart. And the second one, that is for personal account. Now personal account means debit the receiver. Whichever party out of the two parties, whichever party is receiving, you have to debit that party's account, that person's account. So debit the receiver and credit the giver, and whosoever is giver, you have to credit that person's account. So debit the receiver, credit the giver. The third one, that is nominal account. In case of nominal account, debit all expenses and losses. It means whatever expense or losses that occurs in the business, suppose stationery, postage, and any other expenses related to the business has occurred, or any kind of loss, suppose bad debts has occurred, then that is to be debited. So debit all expenses and losses and credit all incomes and gains. Suppose you have received interest, commission, dividend, then all that are coming in the incomes. So any kind of gain or income for the firm, then that is to be credited. Okay, so debit all expenses and losses, credit all incomes and gains. Okay, so you have to remember this rule by heart. By revising it 2 to 3 times, you will be able to remember these three rules of three different accounts. Now after understanding the rules of debit and credit of all the three types of accounts, we'll do the practical sum, that is from your exercise page number, that is 50 according to my textbook, and question number 4, that is to which account the following transactions will be debited and credited in the books of Nilima. Describe with reason. Now what you have to do in this question, you have to mention that the following transactions will be debited or credited. Whether the following transactions in that which account will be debited and which account will be credited, that you have to find out, and then you have to give the reason why that particular account has been debited or that particular account has been credited. Okay, so you can see on the board I have done the calculation. That is first column that I have mentioned, that is serial number, or that is the number of transaction. Then afterwards transaction in short that I have explained, and debit effect and credit effect. Already we discussed that there will be dual effect of any of the transaction. One effect will always be debit and the other effect that will be always credit. Okay, so debit effect, credit effect, and why reasons we have to specify. Also it is told in the question. So you have two columns that are made, reasons for debiting and reasons for crediting. Okay, so after clarifying the heading, the sub headings are also over here. You can see debit effect, I have done 3 sub columns. Okay, the first one, that is debit the receiver, that is as per personal account. Then afterwards debit the goods or assets, whatever comes in, right? So any kind of goods or assets comes in, then we have to debit that particular account. If there is any expense or loss to the firm, then debit all expenses and losses. So as per personal account, real account and nominal account, debit effect. Same way for credit effect for all the 3 accounts. Okay. First one, that is giver, we already done credit the giver. So see, credit effect, that would be for giver. Then afterwards any kind of goods or assets goes out. We have already seen in the real account, credit what goes out. Okay, so over here goods or assets, any kind of goods or assets that are sold by the firm, then credit effect would be given in this particular column. And then afterwards income or gain, any kind of credit effect. If income or gain has been earned by the firm, then it is to be credited. So credit in the column of income and gain. And here you have to specify the reasons why that particular account has been debited or credited. Okay, so first of all the formation of the table that has been clarified. Now moving on with the first transaction that has already been given to you in the question. The first transaction is rupees 50,000 brought in cash and started business. To start any of the business, naturally the owner has to bring certain amount of funds in the business, that is called the capital. Okay, so he is bringing 50,000 rupees in cash. Okay, so entry I have written first of all the transaction over here in short, rupees 50,000 cash brought to start business, short form of business, that is B apostrophe NESS. Okay, so rupees 50,000 that is brought in the business to start the business. So cash comes in the business, we have to always look from the viewpoint of the firm or the business, not from the viewpoint of the owner of the business, because both are separate entity, both are having separate identity, that is the owner and the business. Always we have to look from the point of view of the business, not from the point of view of the owner. Okay, so over here cash comes in the business, that is brought by the owner. So cash account that will be debited. Already we discussed that cash is one kind of current assets. We have already discussed the types of assets in the terminologies of accounting, that is fixed assets, tangible assets, intangible assets, current assets, non-current assets. All that type of assets we have discussed already. In that current assets, that is cash. Okay, so we already discussed that whenever any kind of goods or assets comes in, then we have to give a debit effect. So over here you can see I have written cash account debit. Okay, and on the credit effect I have written capital account credit with the same amount. If I have done debit with 50,000, then capital account also credit I have to do with the same amount, that is 50,000. Means the amount of debit and credit would always be equal. Now capital account credit. Okay, now the reasons are also given why I have debited particularly cash account and capital account. Cash comes in, we already discussed that it is one kind of current asset. So any kind of asset that comes in, so we have to debit that account. So reasons for debiting, that is cash comes in, and reason for crediting, that is cash provided by owner. Okay, so owner is the giver over here. Owner is the giver of the capital over here. So capital account has been credited. Okay, so the first entry is clear. Now moving on to the second transaction. A loan of rupees 10,000 taken from Jaslin. A loan has been taken from one of the person or individual, that is Jocelyn. Loan worth rupees 10,000. Okay, so you can see number 2 that I have written, loan of 10,000 taken from Jocelyn. So because of loan taken, cash would come in the firm. Okay, so again cash account that would be debited, and Jocelyn is the giver of the loan. Okay, so Jocelyn's account that would be credited because it would come in personal account. We have already discussed that any kind of transaction, whether it may be with a natural person or an artificial person. Over here it's a natural person. Jocelyn is an individual. Okay, so Jocelyn is the giver of the loan. That's why Jocelyn's account will be credited, and that would come in personal account. Okay, and over here cash is one kind of asset, so it would come in real account. So cash account debit to Jocelyn's loan account credit. Reasons have been mentioned. Same reason would come for cash, that is cash comes in, and over here Jocelyn is the giver of the loan. So any kind of giver, we have already discussed in the rule of personal account, that is credit the giver. Okay, so over here Jocelyn is the giver, so her account will be credited, her loan account will be credited. So Jocelyn is the giver of loan amount, that's why Jocelyn's loan account will be credited. Okay, CR means already we discussed, that is the short form of credit, that is CR, and DR, that is the short form of debit. Okay, so everywhere you will find DR, over here CR and CR. Okay, okay, now moving on with the third transaction. The third transaction that is given to you, bank account opened by depositing rupees 30,000. We have opened the bank account and we have deposited rupees 30,000 by opening the bank account. Okay, so the third transaction that I have written, bank account opened by depositing rupees 30,000. Now due to opening of the bank account, bank is the receiver of that amount. Okay, so we have deposited that much amount of cash from our firm to the bank. Okay, so bank is the receiver. Over here bank is an artificial person, it's not a natural person, so it has came in personal account. So bank account debit the receiver to cash account credit, because that much amount of cash, that is 30,000, that we are giving to the bank, we are depositing it in the bank. So cash goes out from the firm in the bank. Okay, so bank is the receiver and cash goes out. Okay, so over here you can see bank is the receiver, so it's a personal account. The reason for debiting bank account, and reason for crediting, that is cash goes out. So already we discussed, that is debit all what comes in and credit what goes out. So cash goes out, that's why cash account has been credited. Okay, now after discussing third one, let us move on with the fourth transaction. A computer purchased for rupees 8,000. Computer is one kind of an asset for the firm. So worth rupees 8,000 computer has been purchased. So you can see fourth transaction that I have written, computer purchased for rupees 8,000. Now computer is an asset. Any kind of goods or assets that comes in the business, then it will be debited, and it is as per real account. Okay, so you can see goods or assets comes in, then computer account debit to cash account credit, because we have purchased any assets, then we have to make the payment. Okay, so that much amount of cash we have to make the payment. So cash goes out, that's why cash account has been credited. It is written in the column of real account, that is goods or assets goes out. So over here cash account that is credited. Okay, sorry, cash account that is credited. So reasons for debiting, that is computer comes in. Over here goods were coming in. Okay, but over here the assets is we have purchased. Okay, so computer comes in, that's why computer account that was debited. And because of purchasing of the computer, we have made the payment in cash, so cash goes out. So cash account has been credited. Okay, so after completion of fourth, let us move on with the fifth transaction. Stationery purchased rupees 1,000. Now stationery is one kind of expense for the firm. Okay, so you can see fifth transaction that I have written, stationery purchased rupees 1,000. So it is an expense. We already discussed debit all expenses and losses. As per which account? That is the third one, nominal account. Okay, so over here stationery expense account debit. Okay, stationery expense account debit to cash account credit, because due to stationery purchase we have made the payment in cash. So cash, that much amount of cash will go out from the firm, so cash account that will be credited. Okay, so this is as per real account and this is as per nominal account. Here the reasons are also mentioned. Stationery purchased is an expense. Whatever the stationery we have purchased for the business, that is an expense. That's why it has been debited. And due to purchase of stationery, cash goes out from the firm. We have made the payment in cash. That's why cash account has been credited. Cash goes out. Okay. Next transaction, that is sixth number of transaction. Purchase made of rupees 20,000. We have made the purchase of rupees 20,000. Purchase of goods. Over here it has not mentioned a name of any asset. If we have purchased any asset, the name of that particular asset would have been mentioned. Over here, purchase made of rupees 20,000. It means it is goods purchased of rupees 20,000. Okay. So you can see sixth transaction, purchase of 20,000. We have purchased the goods. So goods comes in. So debit, purchase account debit. Students, make it clear, if you are purchasing any of the assets, then assets account will be debited. But if we are purchasing any of the goods for the business, then purchase account will be debited, not goods account. Okay, so you can see over here I have written purchase account debit, not goods account debit. Okay, but if it was asset, see over here it was asset, computer we had purchased, so I have written computer account debit. But over here it's goods we have purchased, but so I will not write goods account debit, I will write purchase account debit. Okay, so that is the difference while we are purchasing goods or purchasing the assets. So purchase account debit, that much amount of goods comes in, and the second one, that is cash goes out because we have made the payment in cash. So cash account credit. Reasons for debiting, that is goods comes in. Okay, and the second one, that is due to purchase of goods we have to make the payment in cash, so cash goes out. That is the reason for debit and credit. Next transaction, that is seventh transaction, that is given to you. Purchase is made of rupees 30,000 from Raman. Now already we discussed that how we can distinguish a particular transaction is a cash transaction or a credit transaction. If the name of the party from whom we had purchased is mentioned in the question, then it is a credit transaction, and the word cash is also not mentioned in the transaction. So it is a credit transaction. Okay, so this transaction is a credit transaction. You can see 7 transaction, purchase of 30,000 from Ram. So we have purchased the goods. So again same, that is goods account, that is purchase account, that will be debited to Raman's account credit. Now Raman is the giver of the goods over here. It's a credit transaction. We have purchased the goods, so creditor has been arised. Raman is the creditor for the business. Okay, so Raman's account, that would be credited. You can see the reason why we have not credited over here cash account, because it's not a cash transaction, it's a credit transaction. And over here, because of the credit transaction, creditor has arised, that is Raman's account. Okay, so we have to make the payment at later time to Raman, because still we have not paid the payment in cash. So you can see the debit reason, that is goods comes in because of purchase. We have got the goods in the firm, in the business. So goods comes in, that's why purchase account, that will be debited. And Raman is the giver of the goods. We have purchased the goods from Raman. So Raman has supplied the goods to the business. That's why Raman is the giver of the goods. So Raman's account, that will be credited. Now moving on to 8th transaction of the same question, that is goods of rupees 15,000 sold on cash for rupees 28,000. Goods that is worth of rupees 15,000 that we have sold at a price of rupees 28,000. Naturally, if we are selling the goods, then compared to the cost price, we will be selling the goods by including the profit. So goods that were worth rupees 15,000 that we have sold for rupees 28,000. So you can see 8th transaction that I have written on the board. Goods sold for cash for rupees 28,000. Okay. Now goods have been sold for cash. So due to selling of the goods goes out from the firm, and due to selling, the cash comes in. Okay. So you can see in the goods or assets, cash is one kind of current assets. So cash account has been debited, and the goods goes out from the firm. So sales account has been credited. Students, always remember, purchase account will be debited and sales account will always be credited. So over here, cash comes in, due to which cash account has been debited, and goods goes out due to selling of the goods. That's why sales account has been credited. Okay. Now 9th transaction. Goods of rupees 8,000 sold to Neela for rupees 15,000. Goods of rupees 8,000. This is also one kind of selling transaction only, but over here the name of the person to whom the goods have been sold has been specified, and the word cash has not been mentioned in the transaction. It means this transaction is a credit transaction. Okay. Goods worth rupees 8,000 that has been sold at rupees 15,000. So you can see I have written the 9th transaction, goods of 8,000 sold to Neela Neela for rupees 15,000. Now who is the receiver over here? This is a credit transaction, so debtor relation would arise. Okay, always remember with the data, with the sales transaction, credit sales, debtors would arise, and with credit purchase, always creditors would arise. Okay, so over here we have sold the goods on credit, so Neela is the receiver, she is becoming the debtor for the business. So Neela's account will be debited because she is the receiver of the goods. We are already knowing the rule of personal account, debit the receiver. So over here Neela's account has been debited. To sales account credit, because we have sold the goods on credit to Neela, so goods goes out. Okay, so sales account credit. Neela is the reason for debiting, that is Neela is the receiver of the goods, so debit the receiver, and goods goes out because of credit sales. So credit what goes out as per real account. Okay. Now after completion of 9th transaction, let us see the 10th one. Goods returned to Raman of rupees 2,000. Now in the 7th transaction you can see we have purchased the goods from Raman worth rupees 30,000. Now out of that 30,000, whatever credit purchase, we have returned the goods worth rupees 2,000 to Raman. It means it becomes purchase return. Out of 30,000, 2,000 goods, whatever we had purchased, we have returned back to Raman. So it is credit purchase return. Okay. So see, you can see the transaction 10th one, goods returned to Raman of rupees 2,000. So now Raman is the receiver of the goods. Previously we had purchased. Now we are returning back the goods to Raman. So debit the receiver. Raman's account will be debited, and purchase return account, that will be credited because goods goes out. Previously that goods came in. Now we are returning that goods, so goods goes out. So credit what goes out. So purchase return account, that will be credited. The reason for it, that is Raman is the receiver of the goods because we are returning back the goods to Raman. So debit the receiver. Then afterwards purchase goods return. Whatever goods that we had purchased, now that amount of goods, 2,000 worth of goods that we are returning. So that much amount of goods goes out from the firm. So credit what goes out. So purchase goods that has been returned. That's why goods account, that is the purchase return account, has been credited. Okay. Next one, that is 11th transaction. 11th transaction, that is goods returned by Neela of rupees 1,500. Now you can refer the 9th transaction. We had sold the goods on credit to Neela. Out of that goods that we had sold, Neela has returned goods worth rupees 1,500 to us. So that becomes sales return. Previously that goods we had sold. Now out of that goods sold, 1,500 worth of goods had been returned by Neela. Okay. So you can see the transaction that I have written over here. Goods returned by Neela of rupees 1,500. Always make it clear, the 4 transaction, purchase account always it will be debited. Purchase return, that always it will be credited. Sales account will always be credited, and sales return account will always be debited. The reason for that, because of sales the goods goes out, and because of sales return, that much amount of goods come back in the business. Okay, whatever goods we have sold, we are returning back that goods from that particular customer. So sales return account always will be debited. Okay, and that is because goods of that much amount will come in back to the firm, to the business. That's why sales return account will be debited. To Neela's account credit, because Neela is the giver of the goods, she is returning back the goods to us, right? So as per the rule of personal account, credit the giver. So you can see in the column of giver that I have written Neela's account, that is credit. Reasons that are given, goods sold came back. Whatever the goods that we had previously sold, now that much amount of goods come back in the firm. That's why it has been debited. Sales return account has been debited, and Neela is the giver of the goods, so credit the giver. Okay. Then afterwards, 12th transaction, that is paid rupees 500 for carriage. Carriage is one kind of expense. So carriage is one kind of expense. So expense will always be debited, and due to expense we have to make the payment of that expense. So cash goes out. Okay. So you can see I have written the transaction, paid 500 for carriage. So in the column of expense and losses, as per nominal account, debit all expenses and losses. So carriage account, that will be debited. To cash account credit, because due to expense we have to make the payment of that expense. So 500 amount of cash will go out from the business. So cash account will be credited. That is credit what goes out. So cash goes out. Okay. And reason that is given, carriage is one kind of expense for the business. So debit all expenses and losses, and that much amount of cash goes out. So credit what goes out. Okay, so always as per the rule only, the debit or credit effect of any of the account is to be given. So you have to remember all the three rules of debit and credit of the three accounts. Okay, then afterwards, after completing 12th one, let us move on the 13th transaction. Goods of 200 destroyed by fire. Now we had already discussed that if the goods goes out from the firm, other than we are selling the goods, we are not selling the goods over here, but even though that much amount of goods are reduced from our business, okay, from our stock. So any of the way, if the goods goes out, suppose goods destroyed by fire, goods given as donation, goods given as advertisement for as advertisement samples, then in that cases we have to always credit purchase account. I had already told, if we have purchased the goods, then always purchase account is debited. But over here the goods are going in any other way other than purchase. Over here we have not purchased the goods or we have not sold the goods, but even though that much amount of goods are reduced from the firm due to destruction by fire, so purchase account will be credited. Okay, so over here you can see 13th transaction, goods of 200 destroyed by fire. Now due to destruction, loss will occur to the firm, and already we discussed as per nominal account, that is debit all expenses and losses. So you can see I written loss by fire account debit, that is as per expense and loss column, that is debit all expenses and losses. So loss by fire account debit to purchase account credit. Purchase account credit because if the goods are going in any other way other than selling of the goods, here goods are not sold, but that much amount of stock has been reduced from our godown, from our business due to destruction by fire. So always purchase account will be credited. Okay, so loss by fire account debit to purchase account credit. Over here the reasons are mentioned. Goods are destroyed by fire, so it is loss for the firm, and always loss is to be debited. And goods goes out because of destruction by fire. That much amount of goods has been destroyed, is not now they're existing in the godown. That's why goods goes out from the firm. That's why credit what goes out as per real account. Okay. Next transaction, that is 14th transaction, that is given commission received rupees 5,000. Now that is an income for the firm. We have already studied as per nominal account, credit all incomes and gains. Over here commission is one kind of income for the firm, and due to that income cash comes in, right? So debit what comes in, that is as per real account. Okay, debit what comes in. Over here you can see I have written 14 transaction, commission received rupees 5,000, cash account debit because that much amount of cash comes in the form of commission. Okay, so you have written in the column of goods or assets, cash is one kind of current assets, so cash account debit to commission account credit in the column of income and gains, because commission is one kind of income for the business, and income or gain will always be credited. Reasons are also mentioned, that is cash comes in, so cash account will be debited, and commission is one kind of income, so always we have to credit the income or gain. Last entry, that is 15th entry, 2,000 paid for salary. Rupees 2,000 that is paid for salary. Now salary is one kind of an expense we have to pay to the employees. So salary is an expense, so debit all expenses and losses as per nominal account. Okay, so here you can see I have written in the column of expense and losses, salary account debit, and due to payment of salary that much amount of cash goes out from the business, so cash account that will be credited. Okay, so you can see the reason, that is salary is an expense, and the second one, that is cash goes out, so cash account that will be credited. Okay students, so that's the end of the sum. There are basically two only practical sums in the entire exercise of this chapter 2. Today we have completed question number 4. Do revise, this is very important and basic chapter for understanding the further consecutive chapters, so do revise it again by referring the video lecture. In the next video lecture I will be teaching you the last sum of this exercise, that is question number 5. Till then, goodbye. Keep practicing. Stay blessed.